Generally, finance is the study of banking, leverage, credit, capital markets, money, and investments, along with how they are used by individuals and companies. Many of the basic concepts in finance come from micro and macroeconomic theories. One of the most fundamental theories is the time value of money, which essentially states that a dollar today is worth more than a dollar in the future. Finance is often segmented into public, private, and corporate finance. The public finance sector includes government tax, spending, budgeting, and debt issuance policies that all affect how a government pays for the services it provides to the public. Corporate finance refers to the financial activities related to running a corporation. Personal finance applies to individual consumers and the ways they manage their spending, save for the future, and pay for basic needs. These three categories contain many subcategories, including behavioral finance, intangible finance, experimental finance, and financial mathematics. In addition, finance is often used as a general term to refer to borrowing money on credit to pay for something. For instance, if Dane needs to buy a new bathroom sink for his home remodel but does not have enough money to pay for it, he may use the buy now, pay later credit offer from a large retailer to finance his purchase.
Well, welcome Business 630 students. This is Professor Hassey. I'm a couple days late this first week, and I apologize for that. It'll take me a little bit to get going this summer session, but welcome to our first week lecture of Business 630 Corporate Finance. And I gave you a very brief little video there to explain and get many of you up to speed on the definition of finance and what type of finance there is. We are a corporate finance class. Our class is designed for the advanced MBA student to use in developing critical thinking and strategic policies in regards to finance. We'll be looking at the definitions of risk and return, a look at financial statement analysis, a look at capital budgeting, all decisions making of financial management in this course. So I welcome you all, and I want to thank you for signing on this summer. Summer is not an easy time to take an online class where there's no classes. Everything's done via the Blackboard platform or video, and I appreciate your commitment to finishing out your MBA studies at the University of La Verne. So this first week one lecture, we have 2 videos a week. The first video at the beginning of our week is a lecture video talking about the key topics of the week. And then a second video at the end of the week, which will go over review problems, further definitions of the topics, and examples of the topic of the week in the real world of corporate finance. So this week, our topic is risk and return, but also our topic is just understanding and getting up to speed on the Blackboard, how our infrastructure of our course works, introducing yourself to me in your student discussion forum post, which some of you have already done, and also picking and selecting a company from the Fortune 500. Already the companies of Apple, already the companies of Southern California Edison or International Edison have been selected. And so you all need to select a company this week, and then you'll be doing some work on that company in relationship to the topics of this class. For example, in our first case study, you'll be doing a credit analysis of this company in an APA formatted paper. In case number 3 of this class, you will be doing a financial statement analysis of your company that you've selected in the platform of a PowerPoint presentation. So all kinds of different ways of interpreting and presenting financial data will be discussed in this short but sweet 8-week course. Also, in the second week, next week, I will ask you as part of a grade to meet with me. Have like I like in my online courses to meet with every student during the second week of the session for 10-15 minutes just to go over the course, answer any questions you may have or concerns about the online course, get a chance to get to know you. Part of getting me prepared for that is your bio this week. Explain to me your background, where you're from, where you live, how you got to Laverne. It's all very helpful in me arranging a class that is engaging for you and gets you interested in corporate finance. Okay, so we're going to first of all just go over one brief time. I know a lot of you have already reviewed our Blackboard and reviewed the syllabus of our class, but just remember, if you ever need information, it is all right here in this Blackboard platform. First of all, we have the course syllabus and the information about the class that is in this file folder, course syllabus, calendar, and information. Here is our course important dates of the summer, when your various grade assessments will be due. This week you have for 10% of your course grade the discussion post where you give a little bit of excuse me, a biography about yourself and pick a company to watch over this course. The second week, we have our professor meeting. And the third week is our first case study. And then as we go forward on into the class, finishing up on July 30th with the final case assessment paper to be turned in by that date. And we'll talk more about all that in the coming weeks. And then we go to the Zoom and YouTube links folder, and this is where I'll post every Zoom that we have in our course so you can, in one file, see all the video that I've provided for you. This video here, Business Finance Library Resources, could be a very good thing when it comes to case number one work. It's the D&B Hoover's database in the Wilson Library that you all have access to, which is a great database on all financial data of every corporation in America. So make sure, if you've not already done so, take a look at that video about how to use the D&B Hoover's database at our University of Laverne Library. The next section will be naturally the student discussion forum, where you have some postings to do this week. And also an important forum is every week a section where you can post comments or questions to me that I can get back to you right away if you have any concerns about the course. Then we get into our weekly setup of our course. Every week, there's a file folder which gives PowerPoints of my lecture, which gives the agenda for the week, where you have an idea to see what I'm going to be trying to do this course week. Articles. This week, I'd like you to read an article, Efficient, Chaotic, What's the New Finance? I'd appreciate, we're going to be doing some article review and reading during this course, because remember, our text is not mandatory. It's an optional text for a variety of reasons. I can't see student paying all that money for a text that you might only use maybe 10% of the time in our class. And secondly, I find that the real world articles and articles that I will take from different topics of finance might be a little bit better learning experience for you, the MBA student, in this course. So this week we have an article, and I'd like you to download it and take a look at it. And I'll discuss that in my weekend update video at the end of this week. There's always a section on learning assignments. Anything in red is a description of the assessed work for the week. Then some various videos, definitions about the topics of the week. And I'll talk about these today in my lecture video, but also in my weekend update video at the end of week number one. And then, as you can see, every week is set up. Some of it's still a little bit incomplete because I want to see, how we progress in our class. But again, every week is organized for our course to review corporate finance and help you with your case studies going forward. So we're off and running. Let's take a look at the world of corporate finance. This is a very interesting time to study finance in an MBA program, because being in an MBA program, I believe one of the reasons you are in an MBA program is to further your expertise and your ability to lead and make strategic decisions for an organization, as an entrepreneur, whatever. And here at the present time in our economy, we're coming into in the midpoint of an inflationary cycle. The world of globalization of all the economies in the world are all together. The social, political atmospheres are constantly in a state of flux. The possibility of a recession coming in the next year to our economies is making things a big headache for financial managers, for CFOs, for anybody trying to manage the company's affairs in the world of finance. And as you can see by the dollar bill here, it's time for a lot of headaches in corporate finance. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision making if the corporation is to maximize profits and stay competitive for future success. That's a great MBA paragraph. What it means, if you don't manage your money, you're going to fail. That's pretty well it. In other words, what are the three main sources of capital for a company legally? The borrowing of money, debt, liabilities, both short term with not interest bearing debt like 30-day credit, and long term debt, interest bearing debt. That's one. Two, equity, the issuance of equity, ownership in your company, be it private equity, venture capital, hedge funds, private investors, Shark Tank, if anyone's familiar with that TV show, that is all private equity. And then there's public equity, the issuance of public stock. So that's equity financing is the second one. And third is making a profit to have those profits available for reinvestment back into the company. So debt, equity, and profits are the way of achieving capital. This class is designed about, okay, we got the capital. What's the decision-making profits of what we do with it? Capital investment, asset investment, acquiring companies, providing new products and services, investing around the world in new markets. That's what corporate finance is about in 2023. And at the same time, staying competitive with product distribution, supply chain issues, management and employee management issues. All that adds to for a need and a desire in corporations for top talent, of which this is why you're studying an MBA. There are three principles that guide us in financial management. Three principles that maximize the value of a firm, because that's what the definition of finance is: to maximize the value of your firm to its highest value. Right now, Apple Computer is the highest valued wealth company in the world, over $1 trillion. Might go down a little bit now with these new stupid headsets they got out for $3,000. But be that as it may, Apple has the highest corporate valuation of any business in the world, over $1 trillion. You could almost say that they have maximized the value of their firm. How have they done that? Well, they've had an investment principle to earn a return over what it costs them to get the capital to invest in that asset. It's called investment principle. The cost of capital, the hurdle rate, opportunity cost, weighted average cost of capital. You want to earn more than what it costs you to get or borrow the money, to issue the stock, to take it from your existing profits. That's the investment principle. The second is the financing decision. What mix of debt and equity are you going to have to fund your business? One of the things I'll be asking you to analyze about the companies you select in this course is what is the company's current capital structure? How are they financing assets? That's the mix of debt and equity on the right-hand side of the balance sheet. What percent of the business is debt? What percent of the business is equity? It's got a total 100%. But many companies set strategic financial guidelines by the mix of debt and equity in their business. And then finally, the third is the dividend decision. How are you going to allocate the return to your investors? Well, for banks and investors that lend you money, that's a no-brainer. You have to pay them interest on that debt and pay back the principal at an agreed upon timeline. But for equity investors, that's a whole different story. Unless it's preferred stock, you do not have to pay dividends on stock. But if you don't pay dividends, you're going to have a lot of upset shareholders who are not going to want to continue owning your stock. How do you distribute return to your investors, but at the same time, keep enough of those profits and returns to the company so you can reinvest and grow the business? The investment principle, financing decision, and dividend decision are all key ways of maximizing the value of a firm. And you do all this among the reason of understanding, well, what is an adequate return on an investment? And one of those ways of determining an adequate return to your investors is called the capital asset pricing model. This is discussed in our risk and return section of this week's class. What is the required return by investors in the market, what you feel for your company? How do I attract new capital to my business? Now, if people are going to lend you money, how you attract capital for borrowing means that you have a good credit rating. You can pay back the debt with the cash flows being generated by your firm. But in equity investment, how do you guarantee or how do you show what type of return you'll give to the stockholders? It's called the capital asset pricing model. We're going to be using this a lot in case number 1, case number 2, and our course assessment case. How do we determine what is an adequate return for our business? Study this capital asset pricing model. We'll talk more about it as we go forward in our class. And maybe some of you from your previous studies in business remember this one. One of the ways of determining maximum value of a company is determining what will be its cash flow generated over into the future. Some call it the free cash flow. Many of you probably have heard of Warren Buffett. Warren Buffett is, depending on the month, one of the top 2, 3, 4 richest investors in the world. How did a gentleman from Omaha, Nebraska, become such a dynamic investor in markets? He's able to understand the true intrinsic value of a company, the profits and the cash flow that are generated by the company against what it cost the company to acquire those assets that contributed into that cash flow. It's the free cash flow divided by the weighted average cost of capital to determine the value of the business. This is one of the first things we'll study these first few weeks of our course, is how to determine cost of debt, cost of equity, and what percentage of it is in the company's makeup. Put all these together and you can determine the value of your business in the economy. Free cash flow is the determination of companies' operating profits plus the growth of the business over time. Free cash flow is the cash flow that you use for external paying off of the business. Operating cash flow is to run the business. After you've generated that profit after taxes, what do you have left over to pay interest on existing debt? To pay back the principal on that debt? To pay dividends to shareholders? To buy back equity or stock in your business? And to buy and purchase new assets or investments for the company. That's what free cash flow is used to, and it also encourages growth in your business. The weighted average cost of capital, and many of you probably have already studied this or seen this before. What is our company's overall cost of money? The cheaper money is, the higher the value of the assets that produce those returns are. That's why now today in June of 2023, with inflation, depend on who you ask, anywhere between 6, 7, 8%. The higher the inflation, that takes a bite out of the value of your assets. So companies, especially companies looking to acquire more assets, have to find cheap money. How do they find cheap money? Cleaning up their balance sheets, finding better credit ratings, finding corporate partners or merging with other companies. These are all topics we'll talk about in this course. You know, every day, I haven't told you much about myself, but I have been a professor here at the University of Laverne full-time for about 5 years. Before that, I was an adjunct instructor. And during that time, for 32 years, I owned my own business, an investment banking company. I helped small and medium-sized companies get capital. And every day for the last 40 years, I wake up and look at these 9 indicators of finance. Here's what they've looked like over the last couple of years. All the way to last week, May 31st. To understand corporate finance and be competitive and maximize the value of your firm, you have to be aware of market indicators around you. Where is the capital? What are the risks? And that's a key part of strategic decision making in financial management. I'm not asking you to study all of these on a daily basis, but it'd be a pretty good idea with an MBA degree to kind of understand what are the leading indicators in the markets that tell us what's going on in the world around us to run our businesses. The top 3 equity return indicators. The Dow Jones Industrial Index of 30 stocks as selected by the Wall Street Journal. The Standard & Poor's 500 list of stocks. The top 500 companies as determined by the company or the credit rating agency Standard & Poor's. And the top 2,500 small and medium-sized corporations in America as determined by the NASDAQ exchange. Those are the 3 leading indicators of equity markets in our economy. And as you can see, Standard & Poor's and NASDAQ have done pretty good for the first 5 months of this year. The Dow, not so good. The next key indicator is the 10-year United States Treasury yield. The United States government borrows a lot of money. And if any of you have been following the news over the last month, the Congress and the president have been battling, trying to determine and set a new debt ceiling so we can continue to borrow money and run the government. And it's just been decided in the last week, that agreement. If the United States government needs to borrow money, and let's say that money is going to be out due in 10 years, and they borrow that money in $1,000 allotments called a treasury bond, they have to pay currently, as of last week, roughly around $36.36 per $1,000 on the interest of that debt. That's not very much, is it? Because the United States government has the highest credit rating in the world next to China. It's United States and China have the highest credit. In terms of the market, they will never go in default. Why? They can just print more money and have the economies backing up that money to be able to do that. Any country government can print money, but they're limited by the printing of their money by the size of the economy that's generating taxes and GDP, gross domestic product, to support that dollar or that currency. The United States and China do not have to worry about that. They just print it up. But one of the things to notice is look what's happened to the United States Treasury yield over the last few years. 1.9 in December of 2019, 0.9 in 2020, 1.5 in 2021, 3.8 in 2022, and currently around 3.6%. As the interest rates on perfect credit have gone up, that means inflation. Everybody pays now more for borrowed money. The 10-year United States Treasury yield is considered the risk-free interest rate in the market. The best credit gets the lowest interest rate. And as that 10-year United States Treasury yield changes daily, it affects mortgages, credit cards, auto loans, corporate borrowing like the prime interest rate, all kinds of things. It's a very important indicator of the debt markets in the United States. Then we have commodities, and the two leading commodities in the markets are crude oil and gold. Crude oil, because oil is one of the leading ways that our countries drive the economy. Purchasing oil, producing oil, using oil. And gold is a hedge. Gold is some place to put your money when you think other places like banks, stocks, bonds are no good. Gold prices are up this year. People usually buy gold when they think the economies are in for a recession or high inflation. So those are the two leading commodities that tell us about the markets. And then finally, the three major currency indicators of our economy. The relationship of the United States dollar to the euro, to the Chinese yuan, and to the Japanese yen. United States dollars have been highly valued for many years. They took a little downturn last year, but have been coming back a little bit this year. The dollar is the main currency of our world. Why? Depends on who you ask, but probably because the United States has the most secure government. You don't have to worry about our government failing us. That's in debate sometimes, but pretty good for 240, 50 years, that's been the case. We have the strongest economy and we have the strongest military. And we set, through our purchases and products, world standards of economic indicators. So the United States dollar is a key way of seeing how the currencies are in around the world. Remember, if the dollar is high, American products and services are more expensive in other countries. If the dollar is high, it means that our dollar can buy more currencies and buy more products in their countries with the dollar. So it's a very important indicator in the globalization of our world economy. So these key investment indicators are a good way of understanding corporate finance outside of your company. The United States $100 bill. The Chinese yuan, $100 denomination. Euros. These leading currencies are what drive the world, drive politics, drive social issues, make the environment by which we, as MBA students and MBA graduates, will operate and run our businesses into the future. And this class is designed to see how we adapt, strategize, critical think as these events and indicators change, how we adapt that to our own personal business and financial situation. That's the nature of this course. So in other words, we need to understand finance and the risk of finance in our businesses. So as we move forward in this first week, and today's date is Wednesday, June 7th, and as I indicated earlier, I'm a little late this week. Professor Hasse had some end of the academic year things to take care of, so I'm off to a little bit slow start. But as we begin our studies this week one, this first week you are to tell me a little bit about yourself and your bio, select a company that you're going to study and look at over the course of our 8 weeks, get to know our Blackboard platform and how to use it, read this article about efficient, chaotic, what's the new finance post World War II, take a look at risk and return from the PowerPoint provided in week one, and we'll review all this in my weekend video to be posted this Saturday. And this will be our process every week: a lecture video, discussion video, a review video. So I look forward to working with you all. If you have any questions or concerns about the schedule, your personal schedule, if you can wait till next week and talk about it individually with me in Zoom is fine, but just let me know this week if you have any of those concerns. And I look forward to working with you all this summer in corporate finance. Thanks, everybody. Have a great week, and we'll see you again in a few days. Adios.